Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us here at Ausbiz. Let's get across those moves overnight, and oil prices plummeted after the US suspended its campaign of airstrikes against Iran. However, stocks were mixed, with Wall Street investors awaiting the interest rate decision from the Fed this week and key earnings results from the hyperscalers. Chip stocks suffering another bout of selling before recovering, with the chip index falling more than 2% to be down 21% from its record high just over a month ago. SanDisk led the losses, and Nvidia shed 5% amid renewed worries about circular funding ahead of earnings results this week from Apple, Amazon and Meta. Microsoft also reporting this week. It helped lift the S&P 500 along with Walmart and Johnson & Johnson. Oil company shares tracked crude prices lower, while the gold miners followed the bullion price higher. And in Europe, AstraZeneca maintained its long-term forecast as second quarter profit beat market expectations, while sales of luxury giant LVMH edged higher in the second quarter on strong demand from affluent US shoppers, helping offset weaker spending in Europe. Well, President Trump has said the United States was having good talks with Iran and there was a chance of a deal, but warned that US strikes would resume if negotiations failed. Iranian officials said that Iran would halt its own attacks as long as Trump's self-imposed ceasefire continued. However, Saudi Arabia said it had shot down drones aimed at petroleum targets that had been launched from Iraq by Iran-backed armed groups. Meanwhile, President Trump has called on the Federal Reserve to lower interest rates ahead of this week's FOMC meeting. He said rates should be lowered. We have other countries that are paying less interest rates. We should have the lowest interest rate in the world. Well, US Treasury yields have fallen along with oil prices after the suspension of US airstrikes against Iran and ahead of the rates decision from the Fed. The US 2-year at 4.32%, the 10-year at 4.65%. The Australian 10-year is around 5.05%. The US dollar, it fell against the euro and the yen, while the Aussie is trading at 69.9 US cents. Oil prices have plunged their lowest levels in more than a week after the US suspended airstrikes against Iran. Brent crude futures falling around 9% to settle at $88 a barrel. Gold up more than 1% at around $4,075 an ounce. Copper futures were up marginally. Iron ore unchanged at $99 a tonne. And Bitcoin is currently, it's falling. It's currently at $63,500 US dollars. Let's get across those market moves. Steve Sosnick, Chief Market Strategist at Interactive Brokers, joining us again now. Steve, welcome back to you. So, the taco trade was back. We've been here before, haven't we? And we've heard this rhetoric from the President as well. What did the market make of that? Because obviously, I mean, that's a steep decline by the oil price, isn't it?
Yeah, well, good morning, Andrew. It's great to see you again. It was actually a very interesting reaction because we got off to a very fast start. From overnight futures into the regular open. I mean, we were up about 1% on the S&P 500 and a little bit more on Nasdaq. And then the rug just got pulled. Continuing selling in semis, as you mentioned, SanDisk and some of the others, definitely changed the mood. You could see that the Dow Jones closed higher, which has a bit more, let's call it non-tech bias than let's say the S&P 500 or certainly the Nasdaq. But some of the other indices did well too. We actually had, call it 50% more advancers than decliners today. So it was actually not a terrible day, but it's very hard for for U.S. markets to escape sort of the gravitational pull of the mega cap technology stocks, whether they be hyperscalers or semis, and I think that just dragged us down, and it looms over us as we get into the earnings that you mentioned, the M's on Wednesday, Microsoft and Meta, and the A's on Thursday, Apple and Amazon, and plus a Fed meeting, of course.
Absolutely. Just how critical are those earnings results going to be, Steve? I guess, I mean, the key being, as far as investors are concerned, given the concerns over the vast amounts of Capex being spent at the moment and where those returns are coming from, is there an expectation they're going to continue increasing their spending?
Well, here's kind of the problem is Alphabet gave us, gave me a bit of a scare, and I think should give people in the markets a bit of a pause. My big fear going into the Alphabet or Google earnings, I'm just going to call it Google, it's easier. Going into Google earnings was that they might say something like, "Oh, you know what, we've been spending so much money, we're going to maintain our spending but not increase it," and the market would, they may or may not reward Google under those circumstances, but they would thrash the semiconductor stocks and would have a problem. Fortunately, that did not come to pass for semi investors. On the other hand, they came out and said, we're going to increase, but maybe not by quite as much, but we're going to increase our spending. As soon as they mentioned it at the conference call, down went the stock. It was actually trading a bit higher originally. And so I do worry that we're in sort of a damned if you do, damned if you don't situation where the market is going to freak out if, let's say, Microsoft says, you know what, we're going to cut back our cap spending, or they spend too much and then they penalize the hyperscalers. It's becoming a fairly narrow narrow route to thread. Plus, you have Apple basically zooming into earnings here, which I never like that setup. I don't like when you see stocks too enthusiastic heading into earnings. My concern in that situation, but actually for all of them, is that number one, you set the bar too high. You put in a place where it becomes nearly impossible for the stock to beat it. That was kind of Google's problem, but before that, it was Samsung's problem. It was Micron's problem the day after earnings, the day of earnings that were really good, but then, plunged 30% afterwards. It was the problem with Nvidia, where the market yawned at really good results. So, you do have to wonder, with everybody seemingly fully invested, if not overinvested in some of these names, where does the residual buying come in if they have good numbers? And in the case of Apple, where it's just ripping higher seemingly every day, I think that's more the big risk than sort of the hyperscaler type of spending or not spending that refers to the other three stocks that we mentioned.
Well, where is the sweet spot then, Steve, do you think, as far as the market is concerned in regards to what they're likely to be spending?
I don't know. That's really the problem. I would have thought Alphabet kind of hit the sweet spot, which was a little bit more spending, maybe not as certainly more than they raised the number that they were going to spend. Maybe just meet the street's number on spending, and hopefully you win on all the other aspects of it. There were some aspects of Google's report that were some of the profit gains came from their SpaceX stake, which is already, not what it was at the end of the quarter. So there's some other issues there, but I think you just have to I think if I were to draw up a scenario for these companies, it's beat on revenues and guidance, make sure your cloud revenues look good, and guide your spending in such a way that you don't rock the boat in either direction, because clearly the market is not in love with having surprises in that regard right now.
Steve, beyond the hyperscalers, what you're seeing in tech there, what have you made of earnings season thus far? Are we seeing a broadening of those moves at the moment?
Yes, and that's a good thing. We are seeing this a bit of a broadening market. Even today we even saw the Russell 2000 do okay, which that had some tech stocks that pulled it up before they rebalanced, and then it's moved sideways since they rebalanced that index at the end of June. But in general, there are a lot of days where I look at the market and see that tech is down. Let's say the market is flattish, which we've seen several days recently, flattish, and tech, the tech stocks, let's call it communications and technology sectors, being lower, while at the same time other sectors doing pretty well. So I do think the market's trying to rotate into other winners and look for value and find other stocks that are producing good earnings, because in general the earnings results have been good. Let's say we saw 3M do well, or Johnson and Johnson, as you mentioned. So some sort of old big names are holding up their end of the bargain. But ultimately we've become so top heavy and tech heavy that it takes a lot of work from these other stocks if we're going to have some pullback in tech.
Meanwhile, the Fed, we've got the decision coming up this week. Of course, markets pricing in a 40% possibility that they're going to hike. 100% by November, I think it is. What do you see as that likelihood, given what you're seeing, particularly with inflation, how it's running in the States at the moment?
I don't see the Fed doing anything at this meeting. Actually, prediction markets are actually a little bit below that 37 to 40% that the Fed funds futures are at. Fed funds futures are actually predicting, they're pricing in a hike for September. I tend to think that Kevin Warsh, while he's certainly committed to fighting inflation, I don't think he wants to get that far off on the wrong foot with the president, especially before a midterm when he's continuing to actively campaign for lower rates. I think maybe Kevin Warsh has a couple of meetings before Trump calls him an idiot or something, one of those terms that he used for Powell. But I think, I think that Warsh also tried to buy himself some time with these working groups. So he can sort of credibly say, well, I'm waiting for the results of the working groups before we do anything. Labor market is okay. The June report was not up to snuff, which presents a little bit of a problem because he was sort of portraying himself as a single mandate Fed chair focused mainly on inflation. The dual mandate may be sneaking back in, but I think he's in no rush to hike right now. I'm guessing there had to be some political quid pro quo, basically to say, look, tell the president that he's not going to just necessarily start rates out of the box. But on the other hand, during his previous tenure at the Fed, he was a real hawk. And so I think we're going to have to listen very carefully to what he says on Wednesday afternoon our time, because he's still in that trial period. We don't know what to expect, and we're going to have to hinge on all his words to try to get a handle on that.
Steve, enjoy the weekend. Thanks for joining us on Interactive Brokers.
Thank you so much, Andrew. Talk to you soon. Bye-bye.
Let's refocus on the local market ahead of the open here. Then we are expecting a negative start. Of course, we had a very positive session yesterday. That's perhaps reflecting just that mixed session we got on global markets overnight. So SPI futures off by close to 0.25%. We'll take a look at where we open in just a moment and a number of quarterly updates too, company-wise. We'll get across all of that in just a moment. Stay with us for the open.